Welcome to Investors Insights. Our topic today, out-earning inflation. We've got some great topics today in terms of labor market, in terms of inflation and earnings, and also in terms of the Fed. All of it ties together. And I want to thank my colleagues, Bobby Norman, Trey Booth, and Ty Miller for joining me this morning. They did great research over the weekend to provide this information. And I thoroughly enjoyed our debates and discussions this morning. So, gentlemen, let's start off here because you've got some really important data to share with our viewers. Bobby, labor market. Talk about that for a minute.
Yeah, so we got an update on some inflation numbers last week, and we're focused on one in particular because it is more closely tied to the consumer. So headline inflation was tame in July, but PPI provided cause for concern with the final demand trade service suggesting firms are starting to pass along price increases to consumers. So you can see in this first chart that final demand inflation, shown in red, increased in July. So the producer price index for final demand measures the average change in prices received by domestic producers for goods, services, construction sold for personal consumption. But basically, it essentially tracks the wholesale inflation of goods sold to the final consumer. So we're starting to see businesses pass on the tariff costs to consumers. However, we are seeing a positive in that retail sales indicate that consumers are still spending despite uncertainty and higher costs. And one key aspect for the economy is that the labor market remains the key support. So with claims continuing to show a lack of firing despite slowdown in hiring, but we're watching the labor market carefully here because as you can see in this next chart, firms slowed hiring expectations in April due to the tariff uncertainty and still seem a bit spooked, but are trying to normalize. So you can see that the CEO hiring forecast have improved from decreasing job hiring in April, which was at 39%, to today only being 21% of CEOs decreasing in hiring. So this matters. This matters because consumer spending impacts corporate earnings, and corporate earnings drive stock prices. So the strength of the current labor market so far is winning against higher inflation.
Yeah, and that's why I was so excited to do this vlog this morning, because that's a great example of how so many things are tied together to make it all work. And it's also an example of the amount of detail, the data that we cover to see how we tie it all together to navigate through the markets and in working with our clients on their financial blueprints. Trey, tying into that, keep the conversation going. You had some great points this morning in regards to to earnings. And so I was really fascinated by that. Share that with us.
Yeah, thanks, Greg. Yeah, so looking back at second quarter earnings, that covers, April, May, June period. And so that was a very rocky time for the stock market and for corporate expectations and earnings. There was a lot of uncertainty around how companies would be able to pivot in a paradigm where they have to deal with tariffs, which are taxes on corporate Americans that are importing. How would corporations pass that along? Would they eat it? How would that impact earnings? You can see here in this chart, this shows the S&P 500 second quarter earnings expectations. They dropped post-Liberation Day all the way down to 62.48. Then as earnings started to come out, you can see that those expectations spiked up to 66.84. What does that mean? That means that as 80% of the companies have reported, 9 out of 11 sectors have beaten earnings expectations. Earnings grew at almost 13% on a year-over-year basis when looking at this quarter. So a very strong quarter, and what many expected to be kind of the throw everything out with the kitchen sink quarter. If you're a corporate CEO, there's a lot of talk of tariffs. If you wanted to have a bad quarter, this was a good quarter to have a bad quarter because you could have blamed it on somebody else. We don't want to raise prices, but we got to blame it on the other guy. So the fact that corporate America was able to pivot and not only meet but also exceed expectations is a good indication of the innovation that is within these public companies, that they may be able to continue to innovate going forward and produce strong earnings, which earnings at the end of the day drive stock prices. We talk about how the stock market may be expensive. It's expensive relative to earnings. If we can grow our way out of this, and that makes of an expensive stock market very cheap. So if you have earnings growing at almost 13, 14%, it's easy to see the market grow in those rates as well.
Yeah, well said, and ties in very much with what Bobby was talking about. So we keep our eye on all this data, And as you said, sometimes the quarterly earnings and the Fed and everything is not to anybody's advantage. And so we continue to get some surprises in here. Agreed?
Absolutely.
Yeah. So, and Ty, from your standpoint, one of the big topics, that we continue to discuss on this vlog is the Fed. And you brought up some great points about that as well.
Yeah, so the Fed, we're set to hear from them at the end of this week on Friday. They have their Jackson Hole conference. And of course, last time they met, we got some commentary back that they were going to keep rates the same, no rate cuts. But we had two members of the Fed chairman kind of dissent from that decision, and they were kind of for rate cuts. So at this point, we want to hear some kind of commentary from them regarding rate cuts. That is the main thing that's going to be in focus. It seems like the market, but the stock market and the bond market are kind of expecting this, kind of saying maybe the Fed's a little late here. The employment report that Bobby referenced does show, not an overheating economy, slowing of hiring, but not much firing. So we appear to be in a good place. And we were at about a 95 to 98% chance that they were going to announce a rate cut for September. But then, of course, as Bobby mentioned, we got the PPI number, and which was a little hotter than expected. The Fed's pushback has been tariffs cause inflation, which we don't wholeheartedly agree with, but that is their stance. And so that's kind of been the pushback. So we saw expectations come down, as you can see in this chart, to right now an 85% chance of a rate cut in September. So that's what we're going to keep our eye on, just kind of the commentary on Friday. We won't get that decision on Friday, but we'll get the commentary of what to expect for next month regarding a rate cut. Another interesting point to throw out there regarding the Fed is the possible appointment of Stephen Myron. Stephen Myron we had a Fed chairman leave the board, and so President Trump has the ability to nominate someone else, but they have to get through Senate and get appointed and everything like that. That process can take a few weeks. The goal is to get Stephen Myron in there for the September meeting before they announce the forecast, the dot plots, and then especially before they actually make the announcement regarding rate cuts or keeping rates level. The interesting part of this is right now, it's just going to be a temporary kind of seat for Stephen Myron. Fed Chairman Jay Powell has the ability, even if he's not the head chairman, to stay on the board for another couple years. Of course, President Trump would want him to leave. If he does leave, we would expect Stephen Myron to become a permanent member, and then either Kevin Warsh, Christopher Waller, or Kevin Hassett to probably become the Fed chairman as of right now, the way it looks. Of course, we know President Trump can throw some curveballs at you. But if that is not the case and Jay Powell wants to stay on the board for those couple of years, then Stephen Myron might have a very short stay at the Fed and be replaced by one of those three individuals.
Yeah, so there's a lot of moving parts, not only in terms of positions on the Fed, but earnings as well as consumer spending, those inflation numbers, a lot to keep up with. But we like to discuss that with our clients. And Ty, thank you for going over those names and possibilities. We do a lot of what-if scenarios here at Five Plan Partners just to see what the rippling effect can be of decisions that are being made out there. And we also are excited that we have Lexi Watts as our new marketing manager. Lexi is helping us make these vlogs. She's done an incredible job here. We looked for Lexi for 2.5 years and finally found her and excited about it to relieve Felicia Ludlam, who's done a phenomenal job over the years with our vlogs. And so Lexi's going to continue not only the tradition of Five Plan Partners to bring you the vlogs, but also we're going to continue to expand our social media, LinkedIn, Twitter, Facebook. We're going to look at YouTube, our podcast, more and more ways that we can communicate as frustrated educators to give you more information so you won't have high anxiety when that headline news hits and you go, oh my word, how does that impact me? So we want to continue those things, and we definitely want to continue you giving us ideas on ways we can improve our communications and our services. We thank you for believing in us. We hope you have a great week. Can you believe we're almost through August and heading for Labor Day. Football season is close by. And also, we hope and we'll watch closely that we continue to bring you a lot of positive economic news, or at least let you know how we're going to navigate. Have a great week. Talk soon. And always know we're striving here to make our clients' lives better, richer, fuller. We thank you.